When an investor suffers from overconfidence, he or she rates oneself as above average when making investment decisions. Being overconfident often leads to overestimating the probability of good outcomes. Overconfidence can cause people to focus primarily on the upside of investments, while underestimating the probability of poor outcomes for events over which they have no control. In many studies on this particular investor behavior, the following question is often asked. Consider your driving ability in relation to others on the road. Are you a better driver than average? Most surveys show that 80% to 90% of drivers consider themselves above average. This is clearly impossible. In a 2006 study, 300 professional fund managers were presented with a number of questions, and one related to overconfidence. In an attempt to see just how over-optimistic fund managers were, they were asked, "Are you above average at your job?" Some 74% of the sample thought themselves above average at their jobs. Many wrote comments along the lines of, "I know everyone says they are, but I really am." Of the remaining 26, most people thought they were average, but very few, if any, said they were below average. Consider the historical performance of emerging market stocks from 2005 through 2014. For the first 3 years, stocks in these regions produced impressive returns, generating double-digit percentage gains. Based on this stellar track record, what would a typical investor have experienced in 2008? More of the same, correct? Well, 2008 was quite dismal for investors in emerging market stocks, as they lost a little more than half of their investment, 53.2% to be exact. In 2009, however, emerging markets rebounded, producing a return of 79%. Could this be the start of another string of impressive returns? Well, yes, in 2009 and 2010, but in 2011, emerging market returns were negative, down 18.2% after 2 consecutive years of strong double-digit returns. 2012, 2013, and 2014 witnessed performance reversals once again, with returns of 18.6%, negative 2.3%, and negative 1.8% respectively. It's important to take advantage of the potential upside, but to also consider the possibility of yet another year like 2008 or 2011 in the future. One period of returns may be enough to create overconfidence among investors. Investors should avoid overestimating their ability to predict future outcomes, basing their decisions on past trends or performance. Concentrating only on the upside potential while dismissing the possibility of poor performance can be quite dangerous. It's important to take a long-term view when investing.